I'm often asked, why would a long-term investor entirely close one of their positions? As long-term investors, we don't make predictions. We let the market tell us where it wants to go. If the market goes higher, I'll take profits. And if it goes lower, I'll add to my position. If it just goes sideways, I'll do nothing and hold on. As a long-term investor, my top priority is to identify quality investments that I believe in for the long term. And for me, long-term means a minimum of 5 years, and more likely a time horizon of 20 years or longer. Therefore, I never close positions if they've just sold off with the rest of the market. I never ever sell into a market panic. Just because a stock has dropped in a systemic sell-off doesn't mean it's no longer a viable long-term investment. In fact, it may just mean that the stock is on sale and that it's time to add more to the position, not close it. However, I've had many viewers and readers ask me, okay, so when do you close a position entirely? Here are the specific circumstances that will cause me to close a position. My investment thesis is broken. If a company does something that fundamentally breaks my reason for owning it in the first place, I will close the position immediately. For example, I invested in AT&T because of its high dividend yield and its exposure to streaming through its ownership of Warner Brothers and HBO. When management announced it would be selling off its streaming service and cutting its dividend substantially, I closed the position entirely. Even though the stock had popped on the news, my thesis was invalidated. At the time of recording, AT&T is now down more than 50% from where I sold. Financial irregularities. If a company announces that it has found financial irregularities in its accounting, I close the entire position immediately. These issues will often cause a stock to sell off substantially, so there's no point to sticking around. I'd rather get back in at higher levels than risk exposure to the downside that can come from financial issues. For example, on March 17, 2021, Plug Power announced that many of its past quarterly earnings reports were incorrect and may contain financial irregularities. I sold my position immediately. Plug is now down more than 75% from where I closed the position. The CEO or CFO unexpectedly resigns. It's never a good sign when upper management resigns unexpectedly, regardless of the reason. Depending on what happened, I may not close the position entirely. I may just sell enough to remove any remaining capital out of it so I can play with the house's money. But I do take action. For example, Bracken Darrell, the successful CEO of Logitech, one of my long-term core holdings, unexpectedly announced that he would be resigning. While I still believe in Logitech for the long term, I took all of the remaining capital out of the position. Logitech has since rallied more than 10% from where I took out my capital, but that doesn't mean this rule is wrong. As a long-term investor, I had to weigh the risk of the company losing a powerful leader, and that meant eliminating any risk to my capital. There are certainly times when I must consider closing a position entirely. However, I'm not a trader. If one of my positions drops significantly during a systemic market crash, that's a buying opportunity, not a selling opportunity.